Hello, this is Derek Iswell, Chief Investment Officer for Shelton Capital Management with the Shelton CIO Minute. Last week, we spoke about interest rates around the world and their effects on the dollar exchange rate. We feel this is an important factor to watch because the strength or weakness of the dollar is important for international and emerging market investing. So we had spoken about how the actions of the Bank of Japan had affected the yen, and this has been a primary driver of dollar weakness over the previous 6 months. But and as much as the yen will continue to be important, we also want to look at some of the other currencies that are going to be important in determining dollar exchange rates as well. Now, the Federal Reserve has been accused of being behind the curve in tackling inflation, but relative to Europe and the UK, they're actually ahead of the game. US inflation cycle started earlier and triggered our central bank reaction even sooner. And as a result, inflation has also begun to recede sooner than it has in Europe and the UK. Net result is that while the Fed is talking about 25 basis point hikes in the next month or two, perhaps, and lower rates later this year, when you're talking about the UK and Europe, the UK just downshifted from 50 to 25 basis points, and Europe is still raising rates at 50 basis points per meeting. This chart shows how that's affecting forecasts for rates going forward. It shows economists' forecasts for central bank overnight rates during the next 2 to 2.5 years for the US, Canada, UK, Europe, and Australia. The decline in the Fed funds rate, thanks to our earlier action, is forecast to be more rapid than the other currencies, and that's why the slope in that line is much steeper. As these non-US rates, which are declining at a lower rate, become more attractive to investors, more funds will flow to these markets from the US, and their currencies are likely to be propped up relative to the US dollar. Now, as we said, dollar weakness is a key catalyst for improving performance in international emerging markets going forward. During the last extended period of dollar weakness, which was 2003 to 2008, emerging market equities outperformed the US by 25%, or about 5% per year. Given the relative strength of the US market over the last 10 years and the resultant difference in valuation levels because of that performance, they are certainly positioned to do so again. Thanks for your time, and for further information, contact your local Shelton Capital representative. This has been a Shelton Capital CIO Minute.